Somewhere right now, there's a retiree sitting on their porch, sipping coffee, and a check just landed in their account. They didn't work for it today. They didn't sell anything. They didn't even check their phone. That check showed up because years ago, they bought a handful of boring, unglamorous companies and simply let them pay. That's the entire promise of dividend investing, and it's why this topic refuses to go away no matter how many trendy new asset classes show up. Picture someone hands you $10,000 right now and tells you it has to go into dividend-paying stocks, not growth stocks, not crypto, dividend payers specifically, the kind that cut you a check just for owning them. What would you actually buy? Today, I'm walking you through exactly 5 dividend stocks I'd put that money into. Real companies, real yields, real trade-offs, including the one stock on this list that pays the highest yield of all 5 for a reason some people will find genuinely uncomfortable. Stick around, because we're building this list in a very specific order, from the safest, most boring name, all the way to the riskiest, highest-paying one. By the end, you'll understand exactly why that order matters. Let's clear something up first, because a lot of people get this backwards. A dividend isn't free money. It's not a bonus the company is generously handing you. It's literally a portion of the company's own profit, paid directly to you simply for owning a small slice of the business. No job required, no hours worked, just ownership. The reason dividend investing has stuck around for over a century, while 100 trendy strategies have come and gone, is boringly simple. Companies that can reliably pay you a growing amount of cash every single quarter, decade after decade, tend to be run by people who actually know what they're doing. A company can fake growth projections. It's much harder to fake an actual cash payment landing in your account like clockwork. The 5 stocks in this video aren't just high-yield picks thrown together because they looked good on a screener. They're arranged deliberately, starting with the stock built almost entirely around not letting you down, and ending with the stock that pays you the most precisely because it's asking you to accept the most risk in exchange. Quick pit stop before we get into it. I'm not a licensed financial advisor, and nothing here is personalized advice. Think of this as me walking you through my own reasoning, not handing you a guarantee. Dividends can be cut, reduced, or eliminated entirely at any time for any company, no matter how long their track record. Always do your own research, or talk to a professional before you put a single dollar anywhere. Okay, disclaimer done. Let's get into the money. Dividend stock number 1. Johnson & Johnson, J&J. Allocation, $3,000, 30%. If dividend investing had a mascot for "will not let you down," it would be Johnson & Johnson. This company has raised its dividend every single year for over 60 consecutive years. Sit with that number for a second. 60 years. That means J&J was raising its payout through the 1970s oil crisis, the dot-com crash, the 2008 financial collapse, and a global pandemic that shut down the entire planet. None of it stopped the raise. The current yield sits right around 2.3 to 3.2% depending on the day you check, which honestly isn't the flashiest number on this list. But here's what that modest yield is actually buying you. Genuine diversification within a single company. John D isn't just one product line you're betting on. It's pharmaceuticals, medical devices, and consumer health products spread across a business so large that when one division has a rough quarter, the other 2 are usually there to pick up the slack. The payout ratio, meaning how much of the company's actual earnings go toward the dividend, sits around 60%, which is a genuinely healthy, sustainable number. Companies pushing 90 or 100% are essentially betting the farm just to keep the streak alive. John D isn't doing that. It's paying you comfortably, with plenty of room left over. Here's the honest trade-off, because I promised you I wouldn't just hype every pick. This isn't a stock that's going to double your money in a year. It's slow, it's steady. It's the financial equivalent of a well-built house that's been standing for 60 years and shows no signs of falling down. If you're looking for excitement, this isn't it. If you're looking for the stock you can own and genuinely forget about for the next 2 decades, this is exactly it. That's why J&J gets the largest single slice of our $10,000, 30%. Not because it pays the most, it doesn't, not even close on this list, but because it's the foundation, everything else on this list gets to be a little riskier around. Dividend stock number 2, Realty Income. Allocation, $2,000, 20%. Realty Income has actually trademarked the nickname the monthly dividend company, and once you understand why, you'll get why that's not just clever marketing. While almost every stock on this list pays quarterly, Realty Income pays you every single month, which sounds like a small detail until you're actually retired and trying to match your investment income to your monthly bills the same way a paycheck would. The current yield sits above 5%, and this company has raised its dividend well over 120 separate times since going public. Not 120%, 120 individual increases. That's not a typo, and it's honestly one of the more remarkable dividend track records in the entire market. Here's how the business actually works, because it's genuinely clever. Realty Income is a REIT, a real estate investment trust, meaning it owns thousands of commercial properties and leases them out under what's called triple net leases. In plain English, that means the tenant, not Realty Income, covers property taxes, insurance, and maintenance. Realty Income just collects the rent check. It's landlording with almost none of the headaches landlords usually complain about. Now, the honest caveat. REITs are legally required to pay out the vast majority of their taxable income as dividends, which is exactly why the yield is so attractive. But it also means less cash gets reinvested back into growing the business compared to a typical company. REITs are also genuinely sensitive to interest rates. When rates rise, borrowing gets more expensive for a company that relies on debt to buy new properties. And that can pressure the stock price even while the dividend itself keeps chugging along. 20% here gives this portfolio something Jan-J alone doesn't. Real estate exposure, monthly cash flow instead of quarterly, and honestly, a psychological win. There's something genuinely satisfying about a dividend check showing up in your account every single month instead of waiting 3 months between payments. Dividend stock number 3, ABV. ABV allocation, $2,000, 20%. Now we shift from steady income to income that's actually accelerating. AbbVie is a pharmaceutical company that spun off from Abbott Laboratories back in 2013, and in the years since, it has done something genuinely rare in the dividend world. It's increased its payout by roughly 330% since that spinoff. Let that number sink in for a second, because most of the stocks people call dividend growers are talking about growth in the single digits annually. AbbVie isn't doing that. It's been raising its dividend aggressively, including another increase of 5.5% as recently as October of last year. And the current yield sits in the 3 to 3.6% range, depending on where the stock is trading. Here's the story behind that growth. AbbVie used to lean enormously on one single drug, Humira, for the bulk of its revenue. When Humira lost patent protection and generic competitors flooded in, a lot of analysts predicted AbbVie's growth engine was about to stall out completely. Instead, the company had already spent years building up newer drugs, Skyrizi and Rinvoq specifically, and those two alone have grown fast enough to more than replace what Humira used to bring in. That's the kind of successful pivot that doesn't happen by accident. The payout ratio here sits at a genuinely comfortable level, under 50% by some measures, meaning there's real room left for those dividend increases to keep coming, not a company stretching itself thin just to maintain appearances. The trade-off worth knowing: pharmaceutical companies live and die by their pipelines. Patents expire, clinical trials fail, regulatory approval isn't guaranteed, and AbbVie has actually run into some approval delays on newer treatments this year. Nothing related to safety, just the slow grind of the regulatory process. That's simply the nature of betting on a drug company. The payout depends on the pipeline continuing to deliver, not just on past performance. 20% here is the growth engine of this dividend portfolio, the piece explicitly betting that today's yield keeps climbing meaningfully faster than inflation, year after year. Dividend stock number 4, Verizon, VZ. Allocation, $1,500, 15%. Everyone's heard of Verizon. Almost nobody thinks of it as a dividend stock first. They think of it as the company their phone bill goes to every month. But flip that relationship around, and Verizon becomes something genuinely interesting for an income-focused portfolio. The current yield sits in the 5.8 to 6.2% range, and Verizon has now delivered 19 consecutive years of dividend increases, the longest active streak of any company in the entire U.S. telecom sector. For context, that streak started before the iPhone even existed. Here's what makes this pick specifically compelling right now, rather than just historically. Verizon just closed a $20 billion acquisition of Frontier Communications, pushing its fiber broadband subscriber base up nearly 42% year over year. And, maybe more tellingly, the company posted its first positive quarter of new postpaid phone customers since 2013. That's a business that had been quietly bleeding customers for over a decade, suddenly turning a corner. The stock is also trading at a genuinely low valuation, under 10 times projected earnings, which in plain terms means you're not paying a premium price for this yield. You're getting a business showing real signs of a turnaround, priced like nobody's noticed yet. Now, the honest trade-off, because telecom isn't exciting and I won't pretend otherwise. This is a slow-growth business in a mature, heavily competitive industry, really just three major players fighting over the same customers. Verizon also carries a genuinely large debt load, especially after the Frontier deal, and rising interest expenses are a real cost worth watching. This isn't a company that's going to surprise you with explosive growth. It's a company paying you handsomely to be patient while it slowly executes a turnaround most people aren't paying attention to yet. 15% here adds a high current yield, with a genuine, data-backed turnaround story, not just a company coasting on its dividend history alone. Dividend stock number 5, Altria Mio. Allocation $1,500, 15%. And now, the stock that makes people uncomfortable, and I think it deserves an honest conversation rather than either hyping it or pretending it doesn't belong on a serious list. Altria is the parent company behind Marlboro, and yes, that means this dividend is funded by cigarette sales. Let's start with the number that gets everyone's attention. The yield sits close to 6%, the highest of any stock on this entire list. Altria has raised its dividend for 57 consecutive years, a streak that predates almost every other company we've discussed today. The payout ratio runs higher than the others on this list, around 82%. But here's the part that matters. Altria's earnings continue to comfortably cover that payout, even as cigarette shipment volumes decline year after year. That's genuinely the whole story of this stock in one sentence. Declining volumes, offset by aggressive pricing power. Cigarette shipments fell over 3% last quarter, and yet adjusted earnings per share actually grew, because Altria simply raises prices faster than people are quitting. It's not a growth story, it's a cash extraction story, executed about as efficiently as a business can execute one. Altria has also been investing in smoke-free alternatives, nicotine pouches specifically, as a hedge against the long-term decline of traditional cigarettes, though that transition is still very much a work in progress rather than a finished pivot. Here's the trade-off, stated as plainly as I can put it. This is a business in structural, permanent decline. Smoking rates are falling and will likely keep falling for the rest of your investing lifetime. Regulatory pressure is a constant, ongoing risk, not a one-time event. Some investors have an ethical line here they simply won't cross, and I think that's a completely legitimate reason to skip this pick entirely. No further justification needed. This stock exists on the list because it's a real, honest example of how a high yield can be genuinely sustainable and also genuinely built on a shrinking business at the same time. Both things are true simultaneously, and pretending otherwise would be selling you a story, not a stock. 15%, not more, reflects exactly that tension. Enough to meaningfully boost this portfolio's overall income. Not so much that a single ethically complicated, structurally declining business is quietly running your entire retirement plan. Let's step back and look at the whole picture. Here's the full $10,000 split. $3,000 into Johnson & Johnson as the unshakable foundation. $2,000 into realty income for monthly cash flow and real estate exposure. $2,000 into AbbVie for dividend growth that's genuinely accelerating, not just persisting. $1,500 into Verizon for a high yield paired with an actual turnaround story. and 1,500 into Altria, the highest yield on the list, paired with the most honest conversation about risk. Notice the blended yield this creates. Janday pulls the average down with safety. Altria and Verizon pull it up with genuine income. Realty Income and AbbVie sit in the middle, each contributing something the others don't. Monthly cash flow in one case, accelerating growth in the other. Pull any single one of these five out, and the portfolio doesn't just lose a stock. It loses an entire category of what dividend investing is actually trying to accomplish. And this isn't a set-in-stone forever answer. Someone who has a genuine ethical objection to tobacco can simply reroute that 15% into more AbbVie or more realty income without breaking the overall logic of the portfolio. Someone earlier in their career, decades from needing this income, might tilt harder toward AbbVie's growth and lighter on the highest yield names entirely. The five companies are the toolkit. How you weight them is the personal decision. Here's the thing I actually want you to walk away with today. Every single company on this list has paid a dividend through recessions, crashes, and situations nobody saw coming. And four of the five have been consistently raising that payout for decades, not just maintaining it. That kind of track record doesn't happen by accident, and it doesn't happen to companies being run carelessly. If this breakdown changed how you're thinking about dividend investing, I want to hear about it. Drop a comment telling me which of these five you'd actually own and which one you'd skip entirely. I read every single one, and it genuinely shapes what we break down next. And if you want more videos like this, hit subscribe, because we're just getting started. One last time, because it matters. This isn't financial advice, so always do your own research or talk to a professional before you put a single dollar anywhere.